So, CERN Basher, I was listening to CNBC earlier today, and KKR's Henry McVeigh was talking a lot about where we are in the economic cycle right now. And, can this continue? He was talking about that people have no idea, that people really, even the sophisticated investors, are not putting enough emphasis on the productivity that's coming from AI. And of course, we've just written a book on that, and a lot of it has to do with productivity. But he was talking about the fact that it's not being figured into like the GDP. He was pointing out that this 900,000 reduction in the amount of labor that was just taken by like a couple of weeks ago, they reduced the total number of employees by 900,000. He says that's going to bump up the productivity number.
Yep.
So that means our productivity number was wrong that whole time and should have been higher. But he's saying the AI thing is already hitting. It's going to hit big. It's going to mean we're going to have some really big productivity numbers in the future, which is going to mean GDP numbers are going to be big, which is going to mean earnings numbers are going to be big, which means the S&P is going to keep going like crazy. What do you think?
Well, you should follow that up by saying not investment advice.
Not investment advice.
But to Henry McVeigh's comments, I think the only response is oy vey.
Oy vey.
No, I think he's pointing out something really important. I think that we are going to see probably one of the biggest increases in productivity we've ever seen, sustained increases in productivity that will accelerate over time as AI diffuses throughout the economy and more things, right? And of course, once we have autonomous robotaxis and we have humanoid robots, that's when things really take off.
Yeah.
Right. So we're just at the cusp. We're just at the very beginning, the first few steps here. Yeah.
The video that we did Thursday night, people can go back and look at it. I'll put the card up later. The video that we did on Thursday night, we did talk about some of the AI issues that are already starting to impact. We're already starting to see the top companies in the United States, the top companies probably in the world, are the companies that are AI driven. Their price, their valuations have gone up more. Their earnings are going up more. Their stock prices are going up more. I mean, if you've got AI in your name and you really are in the leadership of some aspect of AI, then you're doing way better than the rest of the economy.
Yeah, right. And not just stock prices, but fundamentally the earnings growth, is a lot higher. Accounting for, what was it, 75%, I think, or maybe 80% of the S&P's earnings growth have come from those companies.
Yes.
Yeah.
And
it's remarkable.
And it's not just about, I mean, there is the business, of course, of these companies are building the tools. So there is the tool building part. There is the pure science part, the training and all that. So that's massive amounts of money being spent, massive amounts of compute being created. But then you get to those practical things, and this is where I watch, and I highly recommend people watch Pierre Diamandis's program. He calls it Moonshots, or he also calls it the WTF. I don't know what that even means. But his show, they talk a ton about the companies that are being formed right now that are using the AI capabilities on a level where it's impacting productivity at the company level or at the you and me level. I know you've talked about how it's improving your personal productivity.
Yeah, it's really interesting though at the company level because we have a lot of legacy software systems where data is kind of locked into these systems and there's all kinds of issues with them. But AI basically makes these systems better. It's not like you have to redo everything. You're just putting an AI layer on top and extracting the data in ways that they never could before. Right. And so that's kind of remarkable because a lot of these legacy systems have really held these companies back. So hopefully one of the things that we all see from that is an improved experience when we interface with our government,
Yeah.
right? So,
Well, there was something about that today.
well, just a quick story for you before you go there. So my mom came down and she's gone through the process to get her green card and become a U.S. resident.
Mhm.
Okay, so it's a very interesting process to go through, but this just a real quick story. So she gets approved. Um, and actually, the same day they told us it would take another 16 months. But anyway, later in the day they approved us. And then of course you need to go get a social security number,
Mhm.
right? But in order to do that, you have to wait for the green card to come in the mail, and then you have to make an appointment, right? And her Florida driver's license, a temporary one that she got, expired between the time that she was approved and before she got her social security number. You can't get the license without a social security number. Even though you apply online, you still have to go in person. And even when you go in person, you still have to wait for the social security card to come in the mail.
Yeah. Yeah.
And even though she has a social security account, she can't log in and see the number until it arrives in the mail. So in the meantime, the Florida driver's license expires and then you have to go through that whole process. So just very inefficient, right? And of course, they're all asking for the same information. The Social Security system is asking for all the information that we've supplied to the immigration
Of course.
department.
Of course. Yes.
They have that in their system somewhere.
Yes.
They know everything about her
Yes.
at this point.
Yeah.
Anyway, hopefully AI can make these systems talk to each other and just make for a smoother process for everybody.
Well, I don't want to get ahead of your slideshow, but there was some news this morning about President Trump and Elon Musk and AI. Is that part of your slideshow? And we should leave
It
it.
is not. It is not. Perhaps you can enlighten us.
Oh, all right. So this morning, it turns out that they're now best buds again, apparently, because the president has agreed that XAI should now come in and basically be used by every single federal agency. Each agency will have to pay 42 cents. I don't know where they came up with that number. The cost to every agency is 42 cents for them to be part of the XAI system, to be able to, as you just point out, layer on XAI on top of their existing facilities.
Yep.
And for that same 42 cents, they're going to get the use of XAI's engineers to help them find the ways to best utilize XAI to do what they do. So that seems like a very good deal for the government. I mean, I think they can't go wrong at 42 cents.
Sounds like a pretty good deal. It's probably a pretty good deal for XAI in the sense that they get access to some data, perhaps for training.
Maybe.
We'll see how that works. And by the way, I don't think there was a feud in the first place, but that's okay. That's another matter.
It's another story.
Yeah.
Whatever the case may be, apparently all is well, and we'll see how that might impact Tesla's hopes and dreams with regard to NISTA, going down that particular rabbit hole over the next few months. All right, so there is the story of the day. If you now, this is going to be showing on Saturday morning probably, so maybe it's really old news by then. But I thought that was a pretty important story.
That was good. We'll see what comes of that for sure.
Yeah. All right. So you've got a slide or two?
I do. Yeah, and we've got some fun ones in this one.
All right.
But first of all, let's start with this. This is actually quite kind of interesting, and I think that you and I probably know this, but not maybe in this way. And this guy, Dave Jones, said, I had to triple check this because I didn't believe it. All of the world's discovered reserves of fossil fuels, the same energy equals the same energy. Sorry, Randy?
Go ahead. You're fine.
Equals the same energy as just 5 days of sunlight hitting the earth. So I'll say this again, all of the reserves that we have fossil fuels now equals the same amount of energy that hits the earth every 5 days.
Right.
Okay. Now, of course, it's impossible to capture all of the energy hitting the earth, but that's astonishing, right?
Yes. Yes.
So, he says solar power is basically unlimited.
Right.
And here's that little diagram a little bit closer. Right. So all of the plant material that decomposes that then is drilled, from 350 million years ago.
Yeah.
equals just 5 days of energy received directly from the sun.
Right, right. Yeah.
So might it be smarter for us just to harness the sun directly rather than have to rely on this whole process?
Yeah, so the funny thing is, you never know where your next bit of knowledge is going to come from. And interestingly, the Trump administration has been, I believe, incorrectly bashing the solar industry, less incorrectly bashing the wind industry, because I think the wind industry, there's some serious bashing that can be done. I'm sorry to use your name over and over. But anyway, the solar industry, I feel like that a lot of stuff they've been saying has not necessarily been true. However, a couple of days ago, I decided, okay, Brian Wang, you're the expert of all experts. I mean, he really is. He's like a nationally recognized expert in this energy
Yep.
situation, in particular on small nuclear reactors and nukes, but also solar and the rest. And I said, okay, help me out here. What's the reality? Is Trump right? Is his energy secretary right? Who was on CNBC all day yesterday with big stories. He says, well, it's nuanced. That is way more nuanced than we've been thinking. And basically, yeah, solar is wonderful, and it would probably be the way to go long term, and probably still is the way to go long term, but long term.
Yep.
And it's going to take way longer than we thought. You can't just pump out bajillions of solar cells, and a bunch of batteries and put them on the hills and valleys of the world and take over all the rest of the energy, especially when you're trying to grow the energy
Well, we could
supply.
have, Randy, if we would have started years ago when China
Right.
did. But anyway, that's water under the bridge at this
Yeah.
point. Yeah.
But even China is putting in tons of coal capacity. At the same time they're putting in tons of solar capacity and nuclear, tons of nuclear capacity.
Yeah. And even Elon has said that the fossil fuels are needed in the short term.
Right.
Right. So even he understands that. Um, it's just the rhetoric against renewables to me doesn't make sense.
I agree. 100%.
Right. Lewis Withrow here had a nice little cartoon. There must be a source of energy down there as they're standing under the hot sun.
Yes, 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 yes.
So that for me kind of
Yeah, it does
encapsulates
it.
what we're
That
hearing
does
from the Trump administration right now.
it.
I thought this was kind of funny. The devil is in the practical details, like how to spell the word practical. But anyway, um, like for starters, he says, and so here's a picture of, I guess, the Pacific Ocean.
Yeah, yeah.
Maybe he was trying to show the three places that I've lived in my life in one image:
That's
New
right.
Zealand,
That's right.
Canada, United States.
Yeah, yeah.
So well done. Or maybe he was trying to show how strange this time zone is in the middle here. But I'm guessing he's trying to say that putting solar in the Pacific Ocean is a bit of a problem.
Is that it?
I think so. It was, this is the response under that post.
I see.
But of course, as Slacker Extraordinaire points out, right, but nobody says that we have to convert all the fossil fuel equivalent into electricity every 5 days.
Right, right, right.
Right. It takes well under 1% of landmass covered with solar panels to produce more power than all primary consumption, all fuels on a day per day basis.
Right.
And then Dave responds and he says, welcome to the next devil in the practical detail. He spelled practical right this time.
Good, good.
He says Australia already has the world's highest home solar uptake at near 40%. That's great until you realize it's pushed us into an energy corner where wholesale prices go negative during the day due to all the excess. Where does that lead? Well, to me, that seems like a pretty positive thing if we're driving down costs.
Yeah, yeah.
So I
Except
don't know.
unless you're a utility,
Well,
it's
yeah,
not really good for the utilities.
right.
But it's
But
but it's part
to
of the
me,
future. This is the future.
yeah. To me, energy cost is a bit like a tax, right? Ideally, you want low tax rates, and so ideally, you want low energy costs. Yes, it is the utilities revenue, but they exist to provide a service, and if we can get it elsewhere cheaper, then we should,
Yeah, yeah.
right?
People, again, this is one of the things we'll be pointing out in the book. People have very short memories, and sometimes they're just not old enough to know this. But when I was a wee lad, you did not have your own phone number, your own phone line. You
Yeah.
shared it with people on your block. It costs 10 cents, 10 cents a minute, which back then was a ton. It cost 10 cents for 3 minutes, rather, 10 cents for 3 minutes.
Well, that was real money back then, Randy.
That's
Yep.
right. To call the next zip, and it wasn't even called an area code at the time. We didn't have area codes, but to call the next region, the next 7 miles away,
Mm.
it was 10 cents for 3 minutes. So to call my grandparents, it was 10 cents for 3 minutes. So you're sitting there, you know, you got 3 minutes to have your conversation. This is how much it costs. I was in Europe calling home to my fiance, and we got in a long phone conversation. I wasn't paying a lot of attention, and the phone bill I went down to the hotel the next morning was $1,000.
Wow.
Yeah. Now it's all free, all free.
Yeah.
Yeah.
So, and that's what's going to happen is it's going to be too cheap to meter,
Right.
not just telecommunications, but intelligence,
Mhm.
right? Information,
Education.
energy, labor, transportation. It will all be too cheap to meter. Eventually, we'll just have a subscription to these various things.
Mhm. Mhm.
Food, perhaps, as well.
Mhm.
You just walk into the grocery store, take what you want because you've paid the monthly subscription fee.
Right.
That's the future that we're headed towards.
Mhm.
Don't know exactly when we'll get there, but that's where we're headed.
Right.
All right. So we have a professor of energy and climate policy at Oxford University.
Hmm.
Okay.
Mhm.
So what do you think he's saying?
Let's see. Let me think.
Well, yeah, actually, I'm tricking you here. He actually is saying something that's pretty smart.
Interesting. Okay.
ICE vehicles waste a whopping 80% of energy in their fuel. We've discussed this before, but this is a nice little
A
visual, and
long time ago.
it's nice to see somebody from Oxford agreeing with
Yeah.
us.
Yeah.
He says EVs are propelled by entirely different mechanisms. Energy enters the vehicle as electricity, which directly powers the drivetrain. EVs need not convert one form of energy into another, resulting in much higher efficiency. And here's the graphic up close.
Yeah. Yeah.
And we've all seen this before, but again, if you haven't, take a good look at this. This is why EVs will take over the world.
Yeah. And I think a lot of people, even in this listening audience, may not realize that everything being equal, the cost of energy for your EV is 25% of the cost for an ICE car.
That's right.
Yeah.
Yeah. But it is kind of remarkable. 16 to 25% of original energy goes to the propelling the vehicle forward.
Right. Yeah.
Uh, the heat losses are huge.
Yeah. Yeah.
Whereas for an EV, it's, according to this, 87 to 91%.
Right.
And some of that gets recycled back into the battery. Or he's saying 22% energy is recaptured by the brakes and fed back
Mhm.
into the battery.
Mhm.
Anyway, so that was something good from an Oxford.
From a professor.
Yeah.
And remember, my wife is a professor, so I'm not negative on all professors.
Well, all but one. Yeah. All right. We have a cartoon here. Well, I hate math and math hates me. I think a lot of people feel this way.
I think there's a lot of people that feel that way.
Yeah.
But you and I, we're in a different breed. We
We're a
actually love
different breed.
math.
All right. So let's talk about something that's being talked about lately about stock market valuation, Randy.
Okay. All right.
This chart gets trot out every so often.
Yeah.
The S&P 500 CAPE ratio versus its historical average.
Mm.
So Robert Shiller, who I believe is a Nobel Prize winning economist,
Mhm.
invented this CAPE ratio. The CAPE ratio is simply cyclically adjusted PE ratio. What is that? What you do is you take 10 years of earnings, and you take 10 years because you're trying to adjust out the cyclicality in those earnings.
Okay.
You're averaging those 10-year earnings, and you take the current price over that 10-year average.
Okay.
So it results in a much higher PE ratio for the market because you're taking 10 years of earnings.
Yeah.
Hopefully, a company is making a lot more money today than it did 10 years ago.
Right. Right.
But you're averaging all that as though that was just yesterday.
Mm-hmm.
Okay, so this chart now is getting some attention because we are approaching the all-time high here of 44 back in the dot-com boom.
Right.
And if that was a bubble, then this must be a bubble too,
Must be.
kind of thing, right? And you can see here the average is 18.
Okay, okay.
So you've heard me kind of, get on my high horse and talk about the problems with PE ratios.
I
There's
have.
there's nothing forward looking in any of these numbers.
Right,
It's all looking backwards.
exactly.
Now, for most companies, if you're in a stodgy industry where you're only growing, 6, 7% maybe a year, then fine, doing this 10-year average might be fine, but it doesn't take into account companies like Nvidia, like
Sure.
Tesla, like Palantir, like a whole bunch of others that suddenly hit this hockey stick of growth, this exponentiality in their business models that takes off.
Mhm.
So this is interesting. Just be careful with this.
Yeah.
Um, a lot of people like to talk about this as though this is, physics. It's not.
Yeah. So there's an X account that I actually like called well, I like it and hate it, called the 𝐒𝐦𝐚𝐲 letter. I commonly quote it on my show because it's got lots of lovely graphs and lots of lovely statistics. The problem is his analysis is always just garbage. I'm sorry, 𝐒𝐿𝐴𝐶, but your analysis is horrible, even though your stats look pretty good. They seem to be useful.
Yeah.
This would be a case here of the stats. Okay, these stats are interesting. They might be useful as a rear view mirror, as you point out, but how do we actually want to use them in our analysis? When, as you point out, we're now going into a period. Well, if we look back to the dot-com boom, maybe the piece of analysis that we would want to pay attention to is the run-up before the bust.
Yeah.
So we might want to look at 1990 to 2000 and see that amazing rise as something that in the rear view mirror 20 years ago, 25, 30 years ago, makes sense to see historically what happened during this productivity boom. That might be a valuable piece of information.
Yeah. The number itself for me doesn't really tell us anything. And I've studied this for years. I think it's an interesting metric just to give us an historical long-term perspective.
Mhm.
You can see the 1929 number here, right? And we broke through that
Okay.
with
Yeah.
the dot-com boom, and now it's 44. Before it was 33. Oh my gosh, we're uncharted territory.
Yep.
Okay. Well, now that's like an everyday occurrence.
Yeah. Yeah.
You
Exactly.
know,
That's right.
no one's been talking about this for the last 10 years, and yet here we are talking about it again because we're getting close to this old number.
Yeah.
But when we were at 38, no one was comparing it back to this 33. Um, yeah, it's just interesting. Just be careful with this. Again, you're averaging 10 years of earnings. It's not looking forward. It's like driving a car looking in the rearview mirror. In this
Yeah.
case, you're looking down the road where you were, 10 hours ago,
Right. 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 Yes.
right? You could be in a totally different state now,
Yeah.
right? And we are in a totally different state with respect to the stock market than we were 10 years ago,
Absolutely. Yep. Yep.
right?
Yep.
So just be careful with that.
Mhm.
A lot of people are sounding the alarm over this and saying, stocks are overvalued, get out of the market, et cetera, et cetera.
In fact, let me also make another point. Let me do another rant here. There are several that I know of, and there's probably others that I don't know of, people that are putting out these posts on X that have beautiful charts, scary headlines. They're always scary. They're never positive. They are clickbait. They are designed to get you to look or maybe to buy something. But notice that they're always negative. I stay away from those. Sometimes I look at them just because I want to see what the chart is saying. But if you've got somebody who's posting on X financial information and it's always scary, I would run.
Yeah. Markets go up over time.
Yeah,
So, you can't always be scared out of your mind.
right.
We do make progress.
Yep.
Yeah. Here's another one that's kind of interesting, and I'll just direct you to the bottom of this chart, and it's looking at companies by different market cap categories, right? So we've got mega caps,
Okay.
500 billion and above, there's 17 of them. This is in the S&P 500.
Okay.
Large, between 100 billion and 500 billion is 91 companies. Mid between 25 and 100 billion is 227 companies in that category. And then small, less than 25 billion, 168 companies. Okay, and I'll stop moving my cursor around because we're going to lose visibility of the numbers. But on the right side, we've got the NTM, next 12-month PE. So at least with these numbers, we're looking at the price to earnings based on the expectations for the next 12 months.
Right.
Okay. So the current PE for those mega caps is 31. Okay. The current PE for the large category there is 22.1. The PE for the mid is 19.8, and the PE for the small is 16.5. So you would look at this, and a natural conclusion might be, oh, the mega caps are super expensive and the small caps are super cheap. What this doesn't show you is the growth of these companies.
Right.
Right. Maybe 31 times next 12 months earnings is warranted because those companies, as we saw in the previous show that we did, they're accounting for 75% of the growth in the S&P 500 from an earnings perspective.
Yeah.
That's where all the growth is coming from. Actually, the small cap companies may be expensive because they're not producing any growth.
Sure.
So don't just look at charts like this and tables like this and make any judgments without understanding what's actually driving these numbers. Okay.
Yep.
On the surface of it, they look cheap because you're in the 35th percentile. You're in the bottom, 1/3 roughly. Right. So you might say, oh, I'm going to sell the S&P and I'm going to buy, the Russell 2000.
Right.
That may or may not be a good thing to do. Just don't do it based on just looking at numbers like this.
Exactly.
Okay. All right. Let's get to more specifics.
Okay.
This is kind of fun. Goldman Sachs compared the valuation of the largest tech stocks today versus the tech bubble.
Okay.
So we got December 1999 on the left, and we've got the current on the right. So back in 1999, we had Microsoft, which had a next 12-month PE of 69 times earnings. Okay. Cisco, 101. Intel, 32. Lucent, 49. IBM, 28. Time Warner, which was about to merge with AOL, I think in January, that announcement was made. 217.
That worked out well.
Yeah. Right. And Oracle and WorldCom.
Uh-huh.
All right. Fast forward to today. All of the top companies, NVIDIA, Microsoft, Apple, Alphabet, Amazon, Meta, Broadcom, they're all under 40.
That's an amazing chart.
Right. And again, this is just next 12-month PE, which is flawed, deeply flawed, but at least we're comparing apples to apples here in some sense.
Yeah.
Okay. Now, the one that jumps out at you is Tesla, and you say, oh my gosh, what an overvalued company that must be.
Yeah.
Again, this is to my point that when you value a company, it's based on all future cash flows, not just the next 12 months.
Right.
And Tesla has the potential to have this hockey stick of earnings growth over the next few years. So a higher PE today is warranted because we're expecting much higher growth.
Right.
Okay. But still,
we're only talking about potentially the two largest products in the history of the human race. But other than that, what do they got?
Just the car company, Randy.
The car company.
But the median today of those top companies is 31 versus back in 1999 it was 41.
It's really interesting.
Again, this is not even apples to apples. What was happening with the internet is very different than what's happening with AI today.
Sure.
Okay, so as interesting as this is, again, it's not apples to apples in terms of that. Okay, Stephen Mark Ryan. We don't usually talk about him on your show, but I thought this was pretty funny.
I'm a fan of Stephen.
Yep.
Yeah.
Okay, someone just sent me a copy of their 10-year Tesla valuation model, which caused them to sell Tesla stock in the 200s earlier this year. So according to Stephen, here's the model. Vehicles, the competition's coming. Energy, not cars, therefore ignore. Robotaxi, everyone will press the magic catch up to Tesla button. Optimus, does not fit in my spreadsheet, ignore. Oh, I thought that was pretty funny. Yeah,
that is funny.
And there's a certain person that he's directing this towards that I won't mention here. But. So here's my words of advice to people. Wall Street is always focused on the next 12 to 18 months,
Mhm.
right? And when Wall Street talks about PE ratios, it's usually, the next 12 months,
Mhm. Mhm.
which is what we've just been looking at the last few slides.
Right.
And they typically don't really think about where a company's going to be. Here we are in 2025, we're finishing up Q3. Most people now are looking into 2026,
Mhm.
right? So kind of 15 months out.
Right.
Most analysts are not really looking at 2027,
Mhm.
and they're definitely not looking at 28, 29, 30. If they do, it's just kind of a casual, you know, oh, I think the growth will be decent, but they don't really think about it that deeply.
Right.
And what I'm saying is, if you're a retail investor, you actually have an advantage over Wall Street because you can think 2 or 3 years out, or even longer if you want to,
Mhm.
right? And you've seen the modeling that I do. I look out typically 10 years,
Right.
right? But this is actually a huge advantage that you have over Wall Street, which does not, will not, cannot look beyond the next 12 to 18 months.
Yeah, and of course there are a very few exceptions that do look out longer, but it's really amazing to see those exceptions. And by the way, CERN, thank you for the setup because last weekend, just a week ago from now, I think it was last weekend, I did do my 2026 analysis, my 2027 analysis, and even my 2028 analysis, because if you want to understand the price valuation, if you even want to know the stock market estimate of the price valuation at the end of 2026, you got to be looking at what's going to take place in 2028.
That's right.
And so I just did those, and that's how I came to my year end this year 700 to 1,000, year end next year 1,500 to 2,000. And it's all based on what is Tesla going to be doing 15, 18, 24 months from the point of the stock at that, and where the stock is trading at that time.
Yeah, it's interesting because everybody on Wall Street has been trained in the art of a discounted cash flow model,
Right.
but
They never.
no one uses it. And they don't use it because it's too complex. There's too many variables, there's too many unknowns. So it's easier just to do a shortcut PE method and say, well, the competition's trading at 30 times earnings, but this company's growing faster, so I'll give them a PE of 40. It's much easier, Randy.
So, CERN, let me ask you a question. The President of the United States has recommended, I mean, this guy he's, people totally underestimate him. Nobody else is talking about this, and all of a sudden, out of the blue, he says, we should eliminate the quarterly earnings reports and
Yeah.
go to every half year. We've only been doing quarterlies since 1990, I think. I think
Yeah, I don't know when it started.
I think
Certainly my whole career, that's been the standard.
I want to say it was 1990. It might have been before 1990, but it's not even been my entire career
Yeah.
that we've been doing quarterlies. And he says, this having to, and we know that one of the reasons that companies are no longer going public is because they don't want this, the public hanging over the company in such a cloying way. Maybe going to half year instead of quarterly would help that a little bit. What do you think? What do you think about the idea?
I understand on one level what he's maybe trying to solve is that, certainly the compliance costs of filing quarterly and doing audits and all this stuff is a hassle, putting together the financials, right? And then of course you've got investors that are focused on short term and the quarterly results. One quarter does not make a company. So I get all that. But on the other hand, actually, I would be encouraging just the opposite.
Hmm.
And maybe not officially, but companies should almost today be able to give us real-time information.
I see.
And I think that actually, to the extent that companies can do that, I think that investors will feel a lot of comfort around that.
Hmm.
Now, there's certain real-time information that companies maybe won't share and shouldn't share from a
Right. Right.
competition standpoint,
Hmm.
right? But I'm starting to see a little bit more of a trend in that regard in terms of companies sharing more and more information.
Yeah.
Elon does a nice job of sharing a lot on X.
He does.
right? Just to, not necessarily about business metrics and so on, but
Right,
he's
right.
a very talkative CEO in that
Yeah,
regard, right?
yeah,
A lot of CEOs don't say anything between their earnings calls.
right, right.
So, if we're trying to solve that investors are short-term focused, that's not the answer, Andy,
Hmm.
right? Moving to every 6 months.
Hmm. Hmm.
If we're trying to reduce the compliance costs and all that, make it less burdensome, okay, fine. I'm all for that. That's great.
Yeah, well, in a way, it seems ironic, but it's not really ironic or counterintuitive. If even if they were reporting the main metrics every month, that would in some ways reduce this quarterly rush.
Yeah.
In fact, if you were reporting your metrics every day, it would almost become boring.
Yeah, I
Uh,
mean, in Tesla's case, we get weekly numbers from China.
right.
So China's not a mystery.
No.
We get a lot of daily data actually in some markets in Europe.
Right.
So, why couldn't just Tesla report their weekly sales or
Sure.
even monthly, whatever time period
And then it becomes a non-issue.
becomes a non-issue? It's just,
Yeah.
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 Now the problem is, let's say there's one really bad week, then now you're
Right.
forcing the company to comment on what's going on. It's like, well, okay, we're ramping up. We just took the factory down, and now we're going to ramp it up, and
Right.
you're going to see that ramp in 6 weeks. If it's all contained within a quarter, then maybe you don't have to explain as much of that.
And
But
we've seen the China numbers impact the stock price.
sure,
Okay, they impact the stock price, but then
yeah,
the next week's China numbers will impact it. I mean, if it's a trend, it's a trend. I mean, but that if we had all of it, if we had the European numbers and the US numbers and the China numbers and the everything else as numbers uh, uh, every week instead of just one, and maybe all the same day, or I don't know. Anyway, but I get your point. You'd flatten it out.
yeah,
By actually doing it more frequently rather than less frequently.
yeah. I think so. I mean, wouldn't it be really cool if you could know the production from every factory every day and then the
Yeah,
sales every day?
yeah, yeah, yeah.
I mean, Tesla has that information,
Sure they do.
right? But again, there's some competitive
Yeah, yeah,
factors
yeah.
there you need to
Of course.
consider.
Yep, yep, yep.
Um, yeah. So this, by the way, my comments were attached to this post from
Okay.
𝐒𝐮𝐧𝐝𝐚𝐲 and a piece that Stanley Druckenmiller, I guess, had written or said about why you should never invest in the present.
Mm-hmm.
It doesn't matter what a company's earning, what they have earned. You have to visualize the situation 18 months from now. And I was saying, well, as retail investors, actually, we can go beyond that
Sure.
and front run Wall Street.
Mm-hmm.
Here's the whole comments. I won't spend any time on this. If you want to read this, which is a good little read, just pause it and you can read it.
Mm-hmm.
Um, a little cartoon here. Don't give me all that numbers crap. I know a good market mirage when I see one. Um, yeah. Okay. So lately, there's also been discussion about, valuations high. We need a correction.
I've said it. I've said it.
You've said it.
I've said it.
Okay, Randy. This is directed at you.
Yeah. All right.
So here's all the corrections in the S&P since the March 2009 low after the financial crisis.
Okay.
The average correction has been 8.3%.
Hmm.
We've had a correction as bad as 35.4 during the pandemic.
Mm-hmm.
And we've had a few, garden variety corrections of, 5 or 6, 7%.
Mm-hmm. Mm-hmm.
Um, this is normal. This is
Right.
what stocks do from time to time.
Yep.
They go down.
Mm-hmm.
Most of the time, it's not a big deal. Most of the
Right.
time, it's a buying opportunity. Certainly, the pandemic one was a great buying opportunity,
Mm-hmm.
particularly when the Fed decided to flood the world with money.
Mm-hmm.
Um, so yeah, the correction can happen at any time for any reason or no reason. Okay.
Yep.
I don't know if you have anything to add to this, but
I would just say that I have a strong philosophical bent towards anything that's too extended in either direction
yeah,
being an opportunity. So gold, even though there's no reason to think it will go down because there's all kinds of reasons to think it'll keep going up. If it's up 40% in one year, kind of makes me think I should be selling gold. You know, but sometimes there's a reason. Sometimes there's a strong reason. So then if I can analyze the strong reason and figure it out. So right now, the strong reason why the PE would, why the, I'm sorry, why the S&P, well, the stock market in general, but the S&P as the index of it would continue to go up is if it can grow into its earnings.
Yeah.
Or if the earnings can grow into it, I guess would be a better way to say it. So we've got earnings starting again in just 3 weeks. So
That's right.
we'll begin to see with the banks and then with the retailers, we'll begin to see, is this current how many S&P 500 all-time highs have we had this year?
25, 26.
Might be more than that even, but yeah, in that range, somewhere closing in on 30,
Yeah.
and maybe even higher. I've lost track,
Yeah.
but yeah, so it does have to earn its way, but the way it earns its way is with the earnings. We'll see here in a few weeks.
Yeah. No, I hear you. Just take a look at this column, these two columns, S&P high, S&P low.
Uh-huh.
So if we start from the bottom, in 2009, the high, the S&P at 930, that dropped 5.5% down to 879.
Mm-hmm.
If you bought at the high and then suffered all these declines, you're still doing fine,
Oh yeah.
right? These declines only matter in the short term. And of course, some of these declines lasted a while. Like here's one that's 267 days.
Yeah.
You feel like a fool buying at the high,
Right. Right.
right? It's like, why didn't I wait? Or, here's one, 282 days, right? So just, again, if you're a longer term investor, none of this matters. These corrections, these declines are all buying opportunities, unless you believe that our economic system is going to collapse,
All part. Yes. Yes.
right? Um, Now, if you were inclined to say, well, I'm not comfortable, I've looked at the CAPE ratio, it scares me, I think we're due for a correction, I'm just going to sit in cash. Well, your chances of outperforming the S&P over a 1 year period of about 30%.
Mm-hmm.
Okay. Over a 2 year period, it's about 25. So, quarter of the time. If we fast forward out to 10 years, about 15% of the time, holding cash is a better investment than holding stocks. You get out to 20 years, it's 1%.
Mm-hmm. Mm-hmm.
25, 0, 30 years, 0. 0% of the time,
Yeah.
did cash beat holding stocks. So most people have a pretty long time horizon.
Mm-hmm.
And even if let's say you're 65 and you just retired, you don't need to access all your money tomorrow.
Mm-hmm. Mm-hmm.
Some of that money may need to be around for 20,
Right.
25, perhaps 30 years. Right. So just keep that in mind.
Yeah. Yeah. Yeah.
It's always a scary world, right? The world is always uncertain. That uncertainty is never going to go away. And when the skies feel like they're the clearest, that's probably when the market's going to be at a peak. So you really want to invest when there's the most uncertainty. That's when the best deals are likely to be available.
True.
Right. Okay. And here's that chart, just a little bit bigger.
Okay.
All right. If you recall that previous one where we looked at the S&P high and low, this is sort of showing if you bought at the low and you had perfect timing,
Mm.
it's over a different time period. This is from 2005 to 2024. All right. You put $2,000 invested annually in the S&P. If you had perfect timing, you bought at the yearly low.
Mm-hmm.
Okay, you'd have $186,000.
Mm-hmm.
Impossible to do, but that would be the
Yeah.
best of the best if you could.
Right.
Let's say you just invested immediately. You in this case, you just bought at the start of the year. You had the money, you got a bonus, you invested it.
Mm-hmm.
Be 170,000.
Mm-hmm.
Okay, if you dollar cost average, investing in 12 monthly installments, it's about 167, pretty close.
Mm-hmm.
Interesting that didn't do better than just doing the January 1st one.
Right.
Okay. And I guess it's because over the year the stocks go up.
Yeah,
So
yeah.
you're better off investing right at the beginning of the year than spreading it out over time.
Mm-hmm.
Okay. And then how about this one? Bad luck timing. You invested at the yearly high. You picked the one day in the year where the market was at its peak and you put your money in. Okay. You're still way better off than if you held cash.
Yeah.
Right? Even if you were the worst The
Right,
quote,
right, right,
worst
right,
investor. The fact
right.
that you invested is the smart thing,
Sure.
not when you did it.
Right.
Okay. Now, for a lot of people, this may be a review. So I'm sorry if it's, information that they're familiar with, but I think it's good to remind people of some of these things.
Yeah, sure, sure.
Okay. All right. Um, I think you made a comment about this maybe in our last show, but just be careful about who you pay attention to on X,
Oh, yeah, there you go.
right? Actually, this show you mentioned about this. A lot of people are out there with hyperbolic statements. They tell you how they, dumped their Tesla shares or they're selling the market and all this, that, and the other thing. Um, you know, just don't let them scare you into taking an action that you weren't going to do. I do recommend, listening to multiple people. Don't just
Mhm.
listen to one person.
Unless it's me.
Well,
If
you
I,
would be on the list.
yeah,
Yeah.
yeah.
Right. And Peter Lynch says, the real key to making money in stocks is not to get scared out of them.
Yeah, yeah.
And we may head into a more scary time at some point in the markets, and that this is a challenge, I think, for a lot of investors.
Sure, sure.
Okay.
100%.
But here we are today, and the bears are on the street holding out their cups,
Yeah,
hoping for a few pennies.
yeah.
We don't feel too sorry for the bears, but
Tough time to be a bear.
tough time to be a bear.
Mhm.
All right. I thought this was just a fun, interesting chart. It shows US e-commerce as a percent of total retail sales.
Mm,
So in Q4 1999, it was 0.6%
mm,
of retail sales, and it
mhm.
grew steadily over time. And before COVID, it was almost 12%.
Mm.
COVID caused a sudden and rapid spike up to 16.4. And then we had a little bit of mean reversion as the world opened up again and dropped down to about 14.
Right.
But now we're pretty much back up to that COVID high again, 16.3.
Mhm,
So e-commerce is eating the world of retail.
mhm.
That should be no surprise to anybody, but it's just kind of interesting to see this trend over time.
Yeah, I haven't looked at it in a long time. And when I say a long time, I mean a couple of years. But I've written a bunch of books on bicycle retail. And so I've studied retail backwards, forwards, and inside out. Everything from retail store design to margins and everything else. I think there's gonna always be a bunch of retail stuff that people are gonna want to touchy-feely, our test ride,
Yeah.
you know, I mean, groceries. Yeah, you can buy your groceries online, but man, sometimes you really want to go in and squeeze the melons. So I think it's going to be harder and harder for e-commerce to keep, getting significant gains. Maybe this chart is showing that.
It's interesting because I'm actually surprised that it's still this low.
Yeah, yeah, yeah. For a
We're talking
man,
about,
for a man, it's no big deal.
yeah,
Okay, once you know what kind of shirt you want, if you can rebuy that same shirt over and over, you will.
right.
Okay, but for a woman, it's a whole nother world.
Yeah. Yeah, I've actually had to condition myself to buy like multiple shirts. So it's like, I like that shirt because next time you go back, it's not there, right? So you have to buy like several at once. Yeah. So anyway, it's interesting. So look at this steep line here, right, during the pandemic.
Yeah.
And tell me if you can see a similar line in this chart.
Yes, I can. Yes, yes.
Yeah. So you give people money and they go spend it,
Yeah. Oh,
and
yeah.
they couldn't go shopping, but they bought it, from the comfort of their own homes.
Exactly.
This is M2 money supply,
Okay.
and we're now over 22 trillion. We had a little bit of a dip, and now we're starting to print money again.
Uh-huh.
Um, this is one thing I think that we can count on besides death and taxes. It's a growing money supply. Yeah, I've found a third. Although I think we maybe in a previous show have found a couple other things we can add to that list.
It's possible. It's possible. I
Yeah.
think that this might be an interesting one to uh, do a little more study on, ask Rock about, because the economy is always complicated. It's always complex. So it's always hard to be able to take everything into consideration at any given time. And right now it's more complex than usual. So instead of 2 million illegal immigrants a year coming into the country, we've got 2 million going out already this year, according to
Mhm.
if we can believe the government numbers. 2 million have already gone out at 8 months, 9 months, whatever it is. That's going to impact everything, including even, well, at least the velocity of money, maybe not the supply, because the supply is more based on what the Fed is doing and the Treasury. But velocity of money is going to be impacted by that. But it also eventually might impact what the Fed and the Treasury decide to do in terms of printing. You've got the government chopping, you got Doge, chopping the government down to size, hopefully. And now you've got this new thing with Elon and the president, kind of Doge 2 coming in with AI to try to reduce some of the size of government. You've got all the tariff money that's coming in that's going to be impacting both velocity as well as supply. All of these things are happening at one time, and it might be interesting to see whether we have to or need to print money because of all of that in order just to keep up with the economic needs of the money, or whether maybe we'll be able to stop printing quite as much because some of these things are reducing the needs of the government to in terms of supplying cash to the government.
Randy, I love your optimism, but I think that this blue line will continue to go up to the right.
Okay, all right, this is what yeah, yeah. There you go.
Right. I mean, this was an attempt here to get rid of some of the COVID excesses,
Yeah, yeah,
and they
yeah.
didn't exactly get us back to trend line.
Not very quickly. Yeah, not
Right.
exactly. Yeah.
Oops. Um, I hope you're right. I hope that some of the efforts they're doing will slow the growth of this down, but I doubt it. And Elon doesn't think so either. Okay. No, you can't just print money indefinitely. Well, true. Print money. So I'm encouraged by this. This was actually early this morning on Thursday, September 25th.
Hmm.
And I was actually kind of impressed how quickly it gathered views.
Oh yeah.
Of course, any of Elon's posts do.
Yeah, right, right, right.
But I was encouraged. Again, I've been talking about how companies, by buying back stock, potentially putting themselves in a weak position in the future. We're heading to this uncertain world. I'm encouraged by the fact that Elon maybe is coming around to the Bitcoin topic again,
Oh, okay. I see.
which to me is a natural extension from this comment, even though it's not mentioned here. Anyway, we'll see. We'll see what happens with this.
Yeah, yeah. I have to say it again because not everybody was around in the 60s and 70s and 80s. I've been through now, I think, 10 recessions, and I've written a book on recessions. The worst recession was not 2008. The worst recession was not dot-com. The worst recession was the Jimmy Carter recession
Yeah.
that Ronald Reagan had to solve and Volcker had to solve. And the money stopped. There was no money in the system. It's never happened other than that, in my 55 years in business, I've never seen the money stop. When the money stopped, we were literally going back to barter again
Yeah.
because there was no money in the system. It was just crazy. So we don't
Yeah.
want the money supply to dry up.
Sure. No, there's some important things to consider. And unfortunately, this chart only goes back to like 1981 or 82.
Right.
So we don't capture that period. Yeah. Here's one. We talked about gold earlier. Gold bugs are happy. They got their all-time high.
Again and
Gold
again. Yeah.
again and again.
And silver, even more.
Yep. And then finally, you look like Fed chair material as he's talking to what looks like Edward Scissorhands, perhaps. And sorry, finally, we have one more.
Okay.
A quote from Albert Einstein. The measure of intelligence is the ability to change.
Hell.
Well, wise words.
Or a measure, maybe it would be a better way to say that.
Yeah. Yeah.
I'd hate to try to fix anything that Albert did, but I would think that there might be other measures of intelligence.
Yeah. Now, of course, he might have been, when he said this, knowing what was about to come with the atomic bomb. Yeah. He had certain inside information, Randy, that we don't possess today.
Inside information. Yeah. I've been talking about inside information all week. We've already probably gone long. I wasn't paying any attention to the clock. But we've been talking about inside information that Elon, as the CEO of a company, and particularly this particular CEO, who does like to get into the minutia and the details, knows way more about the future of Tesla than any of us do. He knows more about the present as well as the future than any of us do. And he's just put that $1 billion in. Now, he may have been trying to, get himself a few more shares to put the compensation package over the top. I'm still not 100% sure he's voting his shares. I've seen it both ways.
We believe he is.
We believe he
We
is
believe
voting.
that he's able to.
Okay. I
Yeah.
think I'm pretty sure he's able to, but there may have been a comment at one point where he said that he and his brother wouldn't be. Uh,
Yeah.
but I'm not sure. So there's a little uncertainty on that. But
Right.
anyway, that may have been why he bought then, or it may have been that he just thought it was a good time to buy. The timing would suggest it had to do with the voting of shares. But anyway, but he did make that decision to put his money where his mouth was in a very significant way, and he knows he's an insider.
Yeah. No, I think there's a lot of confidence that investors gain when CEOs of companies buy their own stock in the open market.
Yep.
That's always, most of the time, I think it's a pretty strong signal.
Yep. 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 All right, CERN. Well, I know you're heading off for a week of, I think, business activity. So enjoy your travels, and hopefully it'll be a very successful week for you. And any words of wisdom to leave us with today?
Absolutely none.
Not a single one. Now, you and Wang, in two successive shows, when I've asked about wisdom, neither one of you have had anything to provide.
I've just been providing an hour of wisdom. I have no more.
I see. You have nothing left. I see. Just no more. I see. Okay. All right. That's all we got then. To all of you out there, thank you, of course, CERN, for providing that hour of wisdom. To all of you out there, it's been great talking to you.
Thanks, Randy.